I'm going to begin with you. Is what we're seeing in the market today a sign of investor conviction, confidence that things are going to be okay, or is it something different?
So our indications suggest that the average equity fund, the average individual investor has been bullish, but not necessarily overly bullish. It's quant type funds that are really helping the market. My colleague did a really good story today about those who target volatility. And these include sort of trend followers, CTAs, as we call them, risk parity funds. Bridgewater is a huge one. And they look back and they look at vol, they look at the VIX and they see how low it's been and their models tell them to buy. So usually we sort of are here blaming the quants. We have to give them some credit here.
What do you say, Hugh? Is it a question of conviction? Is it a question of quants reacting to internal signals and thereby deploying capital into the market? What?
Well, keep in mind, Tyler, that quants are unemotional. They really don't get caught up in the day-to-day, week-to-week events that are really scary. Some of these things are really scaring small investors. I disagree with Greg a little bit. I think that I've never seen quite this level of widespread, let's call it pessimism, among average investors. So they're a little bit scared and they're caught up in some of these events. I think what gets them over, why this has been a good market, it's had stops and starts, and why we sort of restart is primarily because in every case, within a period of, say, 2 to 4 weeks, we've had a sort of solution, if that's the word, to some of the problems that we've had. The banking crisis, that's caused us to watch very carefully deposit outflows and bank lending. We're watching deposit outflows. We're watching bank lending. They seem to stabilize. That's helped investors. Now we've got the debt crisis, of course, the problem of a possible default. We're watching very carefully. We hear the words like, worldwide recession, but at the same time, we look at the details of the agreement between the House of Representatives and the president. And then when you look at it, the level of fiscal stimulus that's being removed, the level of, shall we say, restraint, non-defense discretionary spending is not much, exactly. And so investors will now get over that so-called default crisis or concern. So every time we get a crisis, every time we get an event like this, you bet investors are scared. You bet investors back away from the market. But at the same time, to some extent, they come back to the markets, largely because we start to see what looks like, I don't want to call it solutions, but something close to solutions.
Mm-hmm. That said, Greg, the sort of quants are our friend until they're not. I mean, we always pile on them at the first sign that they're, causing a panic or, So, what would you be watching for in terms of, when they flip the switch and start kind of pushing the market the other way?
Yeah, so I look at the VIX. The VIX at about 20 or so, it gets above that level and their models, and you don't want to generalize about quants. It's like saying mutual funds kind of thing. There are a lot of quants who do different types of things, but the ones we're talking about, trend followers, risk parity kind of guys, they look back. And like Bridgewater, they'll look back longer than some others, but they look at the VIX, and when it gets high, then they start getting concerned, or their models do anyway, and they do some selling. But the fact that it's been relatively low for more than 6 months, it's been dropping for a little while over the past year. So if you want to go back that far, that's telling them to buy. But yeah, I would look at the VIX.
Hugh, let me turn to sort of questions of portfolio structure and management and where we are according to your models. If I am an average equity investor and I like to keep 60% stocks, 40% fixed income or cash, something like that, would you be, or 65%, 35%, where would you be right now?
Well, I'm a little bit concerned about a hard landing. I'm not saying that the hard landing is going to derail this so-called good market or bull market, but I'm concerned that we might see a little bit of a decline in stock prices as a result of that. What I'm seeing from the market sectors is I'm seeing positive performance from some bull market sectors. That's the good news. I'm seeing some good performance from the so-called defensive sectors like utilities and staples. That tells me, Tyler, in direct answer to your question, if you're 35 to 65% equities is your comfort range, be it about 50%, have a little defense in your portfolio, have some offense in the terms of technology and maybe communication services, in your portfolio. In other words, a very balanced portfolio without a big bet to the upside or a big bet to the downside.
Hugh, good to see you, my friend. And Greg Zuckerman, also to you. Thank you for being with us.